Hi, I'm John Crypto. Silver didn't just fall, it bled out in front of everyone. LSEG data shows that the price dropped 36% from its all-time high of 121.6 per ounce in just a few days. This was the biggest one-day drop since 1982. That doesn't fix it. That's a time to sell everything. That's what happens when a market goes too far and then snaps back like a steel cable, cutting everyone who is too close. The kicker is that this didn't just happen out of the blue. This happened after a 147% rise in the vertical melt-up in 2025 and an even crazier 71% rise in January 2026. In less than 4 weeks, silver went from being a metal that no one cared about to a main character. Retail piled up. Algorithms for momentum chased. Influencers shouted out goals like $150, $170, the moon, and infinity. When the price went over $100 and then over $120, the trap was fully armed. Now put the pieces together. While people were talking about how great screenshots were, something much bigger was going on behind the scenes. On January 1st, 2026, Beijing quietly flips the switch. People now think of silver as a strategic resource. You can now get a license to export. The government needs to give the go-ahead for metal to move freely out of China overnight. The market reacted right away. The price of silver in Shanghai goes up to $124 to $125 per ounce, while the price in India is $103, $106. That's a 17% difference between two big Asian markets. Not because demand in India suddenly dropped, but because China stopped the pipe. When you see a price gap like that, it's not just a guess. It's hard on the body. It's metal that can't get to its destination. Things get worse from here. Only 44 state-approved companies can export silver until 2026-2027. 14. And the standards are tough. They have to make 80 tons of stuff every year and have $30 million in active credit lines. Small miners can't get in. Medium-sized traders, out of here. This isn't rules. It's keeping supplies from one place under control. Traders in the West play games with paper, but traders in China play a whole different game. You have to deliver in person to the Shanghai Gold Exchange. No promises, not deals. There is no metal in the vault. People take it home after they buy it. That means that every time demand goes up, real ounces are taken out of the world economy. These ounces never come back to Comex, never back up futures, and never help shorts. Now take a step back and look at the whole thing. This has nothing to do with coins or jewels. China makes more than 80% of the world's solar panels. Silver conducts electricity, which is why solar power, electric cars, and high-voltage electronics all work. It's hard to find a replacement. You can't make more of anything in a day. When Beijing calls silver strategic, it doesn't mean anything. That means that industry demand comes before exports. Even Elon Musk couldn't ignore it. He goes public to say that not having enough silver could hurt the supply chains for both the electric vehicle industry and other industries. That's not a tweet, it's a flare. When the CEO of a company that needs electricity starts waving his arms, it means that the procurement departments are already sweating. Stop right there, because this is where the story splits in two. On one side, there is physical reality. Exports are stuck. Delivery is necessary. Hoarding at work. Extra fees. On the other hand, you have paper silver, which has futures, leverage, margin, and stops on top of stops. And when those two worlds come together, instability doesn't knock politely. It kicks the door down. That's exactly what happened. When Asia started taking away metal, Western futures didn't slowly go up. They made things very hard. Not based on scarcity, but on liquidity, paper markets set prices. Prices don't go down when liquidity is low. It falls through the holes in the floor. The crisis didn't show that there was no longer a need for silver, which is an uncomfortable truth. It showed that the market isn't very stable. The leverage went up when the price went up. Forced selling began when the momentum changed. The stops went off. Margins got too wide. And all of a sudden, a metal that had been hard to find for 6 years looked like it was falling. People don't want to talk about how different this is. Finding real silver in Asia was getting harder and harder, but the price of paper silver was going down in the West. That's not a good thing to learn. There is a gap so big that a line of armored trucks could fit through it. That's where smart money makes a lot of money. When stores were closed and candles were melting, someone else was ready for this kind of violence. Someone who understands that wealth doesn't disappear when the market is at its most unstable. It just moves. And that brings us to the next part of the story, which no one saw coming. The numbers for the stock, the money taken out of the vault, the time when Comex metal didn't just go down, it vanished. If you thought a 36% drop was bad, just wait until you see what happened inside the warehouses and who was already betting on the crash before the first ounce went missing. That's why this market was never in balance to begin with. Silver didn't just go into chaos, it's been broken for years. This is the 6th year in a row that there hasn't been enough of something, and it's not a small one. There has been a shortage of about 820 million ounces of silver on the market since 2021. That's not a mistake in rounding. That is a lot of metal that doesn't exist in the shadow market. The kicker is that mine production around the world hasn't changed at all. We're stuck at about 1,813 million ounces a year, but demand keeps rising. Solar energy panels, cars that run on electricity, AI data centers, infrastructure for high voltages. Every megawatt that goes into the grid quietly eats silver, and you can't print this stuff like you can with hype assets. A lot of silver isn't mined for silver. It's a byproduct of mining lead, copper, and zinc. So even though demand goes up, supply stays the same. It gets clogged. Now put the pieces together. Even though this gap is getting worse, Western markets still act like silver is just another deal. Futures contracts keep getting bigger. Leverage gets bigger. The amount of money in the vaults is much less than what is on paper. That trick only works until someone asks for it to be delivered. Then the 26th of January comes. At that time, 26% of the registered Comex silver inventory disappears in just a week. No drops. Out of here. Registered means that the metal can be delivered on futures contracts. When that category runs out, it's not just stress in theory, it's delivery stress. The market is saying, we might not have enough. Price changes a lot. As withdrawals pick up speed, silver prices go up almost 12%, reaching about 130s per ounce. That move happened because of fear, not hope. Shorts are in a hurry. Members of the clearinghouse who look at inventories lose money. The system flashed yellow and then orange. Now zoom out. This wasn't just happening in New York. Asia said yes. According to the Shanghai Futures Exchange, the amount of real silver in stock has gone down from 462.62 tons to 449.65 tons. In a short amount of time, that's a drop of 13 tons. This is why SHFE inventories are more important than any RSI or MACD indicator. They show how much real industry is using. Factories are pulling metal. Suppliers are locking up their goods. This isn't just for fun, it's for real. This is the part that makes me uneasy. Inventories don't go down like that unless there is more demand than supply. Prices stop being polite when it becomes a trend instead of just a one-time thing. They get weak, they make a space, they rise, they break apart. They do both things in the same week. Now let's talk about the mind. Retail sees a parabolic chart and thinks chance, but professionals see the same chart and think instability. Retail buys the breakout. Pros wait for things to get better. That's where money changes hands. That's when the real story starts. Everyone on social media was yelling squeeze, but a Chinese trading company called Zhongcai Futures was quietly building up huge short positions in late January. Think about that for a second. When silver broke through $100 and then $120, Zhongcai didn't celebrate. They were getting ready for a fall instead. By the start of February, their short position was equal to almost 484 tons of silver, which was worth more than $1.5 billion at its highest values. There was no risk here. This was a problem in math. Zhongcai had already lost money betting against silver in November. They took the loss, stepped back, let the frenzy build up again, and then went back in when there wasn't much liquidity and they could use all of their leverage. That's not a stroke of luck. That means knowing how to unwind deals that are too busy. This is where the transfer happens. When the price went back up and the stop losses went off, Zhongcai's position made a lot of money. In just a few days, they made more than RMB 3.6 billion, or more than $500 million in profits. Same market, same facts, a completely different outcome. This is the hard lesson that markets never teach you. When things get really crazy, money doesn't just disappear, it moves. From hands that are emotional to hands that are strict. From people who buy things late to people who take risks early. From the crowd to the whale. And here's the funny part. This profit didn't come from thinking silver wasn't worth anything. It came from knowing that paper markets can crash even when real markets are getting better. That's when traps happen, when things don't go as planned. The futures market was busy getting rid of leverage because Comex stockpiles were low and Shanghai was taking metal out. Two realities are going in different directions, but only one of them chooses who lives through the swing. Now think about this. If one company could make $500 million in just a few days of chaos, what does that say about how stable this market is? And more importantly, who will be left with the bill when the next wave hits? But Zhongcai's gains aren't the end of the story. That was just a sign. The real question is who is on the other side of those trades and how much paper silver is still out there that doesn't have any metal behind it. We'll get right into that in the next section. How the trap works, what Western exchanges do, and why this silver meltdown could be the start of something much worse than a disaster. And that's where Zhongcai made the most money. They didn't just get lucky when the market went down, they planned the timing to take advantage of people's weaknesses. Zhongcai Futures closed its short bets and made RMB 3.6 billion, or about $519 million in profit as the market began to fall after reaching its peak. Not because silver suddenly lost all its value, but because the paper market broke down under its own weight. $500 million came out of the mess. Look at the scale now. Their exposure wasn't cute. Zhongcai's negative stance on SHFE silver futures was worth about 484 tons of metal at its peak. That comes out to more than $1.5 billion at prices over $120 an ounce. That's not a hedge, that's a statement. They were betting that the thrill wouldn't last. The problem is that this same company lost money when it shorted silver in November. Most players would have gotten hurt. Zhongcai did the opposite. They watched the flow, waited for the mood to change from hopeful to ecstatic, and then quickly built up their shorts in January, when retail confidence was at its highest. That's when leverage is at its highest, stops are at their closest, and liquidity is at its lowest. This is how professionals handle changes. They don't follow trends, they wait for them to become popular. Now put everything together. The basics alone didn't cause the silver run in January. It grew because of speculation in the retail market, a lot of momentum funds coming in, and algorithmic techniques that work together. More people buy when the price goes up. People buy more, and open interest rises. Then the price drops and stop-loss orders start going off like dominoes. Thin liquidity takes care of the rest. As soon as the sell-off began, bids went away. Not only did futures prices drop, they also fell through air pockets. That's how you can get rid of 36% in just a few days, not because there was no longer any demand, but because leveraged paper claims were being forced to be unwound. And this is where wrong information made things worse. People on forums and social media spread rumors about a silver market collapse. Headlines screamed end of the cycle. Retail traders who were already upset by the whipsaw either sold at the lows in a panic or bought more at the highs. Both results feed the same machine, instability, and people who are impatient have to pay for instability. The truth is that none of that talk changes what silver is really worth over time. Analysts who don't take into account leverage and speculation say that the intrinsic fair value is between $60 and $70 per ounce. This is based on industrial demand, mining economics, and limits on substitution. Prices over $120 weren't based on the fundamentals. They were based on the energy of a compressed spring. Springs break. But here's the part that everyone misses. Even when futures prices were going down because of technical selling, physical stockpiles in Asia kept going down. There was no new stock in the Shanghai warehouses. People who work in industry didn't stop buying. Just because a chart turned red, fabricators didn't cancel orders. The system kept losing metal. That's what it really looks like on a split screen. Breaks in paper, the body gets tighter. And it gets worse when you think about how supply reacts. You can't just turn on silver like you can oil. About 70% of the silver that is mined around the world comes from other metals. You want more silver, you need more copper mines, more lead smelting, and more demand for zinc. That takes a long time, not weeks. High prices don't make new ounces right away. When demand goes up, though, like when solar grids, electric cars, or AI infrastructure become more popular, supply doesn't go up to meet it. It gets behind, hard. This is the main problem that is ruining this market. Leverage and psychology affect short-term paper prices, while geology and industry affect long-term physical reality. When those two are too far apart, things get very unstable. Zhongcai was aware of that. But the store didn't. And keep in mind something important. Zhongcai's profit doesn't mean that silver is done. It just means that the trade is over. A big difference. They took advantage of the instability that came from too much hope. That doesn't fix the basic problem. It just changes the way things are set up. The real question now isn't did silver crash? It's what will happen next if inventories keep going down and paper exposure gets lower. There are fewer forced sellers because there are fewer leveraged longs. And because there are fewer forced sellers, the next move won't look like this one. Don't forget about China's ban on exports. Add in the pull of business. Add in stocks that are getting smaller. That's a coiled shape, not a straight one. And that's exactly where we're going next. To talk about what the drawdowns and export bans mean for the next phase, who's quietly building up while everyone else is busy, and why this silver breakdown may be setting the stage for a move that catches almost everyone off guard. And this is the most dangerous part of it all. After this silver crash, the ownership changed, but it wasn't the end. From weak to strong hands, from stores to whales, from promises on paper to real metal. The futures market was losing money, but real silver was slowly leaving the system. The Comex vaults are getting less full. There isn't enough room in Asian warehouses. And a lot of people are still looking at charts and getting scared about the price. Every time this happens, prices go down and trust dies. And at that point, the people who know how the system works start to take sides. This motion shows that markets for paper make noise, physical markets shape reality, and when the gap between price and reality is big enough, history doesn't repeat, it blows up. In the next step, we'll show you exactly what happens next. Who is quietly buying silver while the news screams collapse? When China's ban on exports really hurts Western markets and why this crash could be the start of the next big rise, which will be very big if you miss that. You won't just miss the next rally, you'll miss everything. So if you've finished giving the system its exit liquidity, when you want to stay ahead of the game, sign up now. Press the button below to like this and say, physical paper. When silver moves again, there won't be enough time to work things out. Just time to respond. And don't forget, stores are the only places where noise is okay. The truth is for people who are ready.